Good morning, students. Welcome back to the session on audit. So today we'll continue with our discussion on audit of insurance companies, and we'll also be starting a new chapter after we are done with this. In the last session, we discussed various audit procedures in relation to the life insurance companies, and we also touched upon some of the requirements related to general insurance companies. So today we plan to get into the details of the requirements related to general insurance companies, how these companies have certain requirements different from the life insurance companies, and what all procedures are required to be covered over here. So moving further on to the requirements related to general insurance companies. About general insurance companies, we understand that in relation to general insurance companies, the insurance is something which is covering other than the risk of life. In very simple terms, if we have to talk about general insurance company, which could be related to, say, car insurance, which could be related to, say, fire insurance, or which could be related to, say, any of the property insurance. Yeah. So there are many types of insurances which get covered over here. But as regards the business of the insurance, it's effectively the same mechanism which is followed in case of this type of insurance also. This is not different significantly from some of the requirements related to life insurance companies, except for the fact that in case of life insurance companies, we generally see that the investment or the premiums or the plan is taken for a longer period of time. That ranges generally from 10 to 15 years or 20 years or 25 years. So that's the general thing that we get to see in case of life insurance companies. However, in case of companies which are into general insurance, the policy period would generally be ranging up to 1 year. It would not really be going up to a period of, say, 10 years, 15 years, or 20 years, or say more than 1 year. Generally we see that the term covers 1 year. Over the period of this term, the insurance is provided. And after the term is over, there's nothing which comes back to the person who would have taken the insurance. For example, if we pay the insurance premium for the car, then the car will get insured for 1 year. After 1 year, if we have paid this insurance premium, we will not be getting anything back. The premium which has been paid has got adjusted towards the risk of the damage towards the car, and it's done there. So there's no return which will come back to the person who would have paid the premium after 1 year. That means in case of general insurance, generally the risk which is covered is the insurance, and there is no further investment plan which is attached to the insurance plan, which we used to see in case of insurance plans and which were in the nature of life insurance. However, whether it covers any sort of investment or not has not really impacted us, because in most of the cases, when we discussed about the requirements related to life insurance, there again, we didn't focus too much on the investments which are made. Correct? We focused primarily on two things. One, that was about the premium which has been paid, and second, that was about the claims, because in case of any insurance company, these two will be the most important items. Now, talking about these two items, once again, in case of general insurance business, let's move on to the requirements related to the accounting standards. Now, in case of general insurance companies, similar to what we saw in case of life insurance companies, there's a specific requirement of ADA regulations, which has been specified in Schedule B. So for life insurance companies, there was Schedule A, and now we have Schedule B. And these regulations talk about various requirements. First part talks about the accounting principles for preparation of financial statements. Now it specifies that the preparation of financial statements of general insurance companies should also be done after applying accounting standards. However, there are certain exceptions over here. First, cash flow statement, similar to what we see in case of life insurance company, shall be prepared under direct method. AS 13 will not be applicable. That is about accounting standard for investments. Segment disclosure as per AS 17 will apply irrespective of whether the securities of the insurer are traded publicly or not. Then the minimum segments have also been prescribed by AAPE over here. Okay. Now these are the requirements. If you remember, we also discussed in case of life insurance companies, and all of these requirements you'll see are similar. Correct? Now moving further on to the understanding of premium. So premium is something which will be recognized as income over the contract period. Similarly, if you'll see, there are requirements related to claims as to how they should be recognized. Then there is a procedure which talks about valuation of investments of this type of insurance company. And then this also talks about any sort of unlisted and other than actively traded equity securities or derivative instruments. Then it talks about any reserves which have been created by this type of insurance company or any loans or advances which they may have given. Okay, yeah. All of these requirements are very much on the same lines which we discussed in case of life insurance companies. So we are not saying that they are exactly same, but the principles which we need to understand are largely same. Here again, there are certain disclosures which have been prescribed and which are mandatory. First is about the contingent liabilities. Second is about encumbrances to the assets of this type of company in and outside India. Commitments which are made and which are outstanding for loans, investments, and fixed assets. Any claims net of reinsurance which have been paid to claimants in or outside India. Actuarial assumptions which have been made for claim liabilities in the case of policies exceeding 4 years. Then the aging of claims, distinguishing the claims between outstanding for more than 6 months and which are less than 6 months. Extent of premium income which would have been recognized. Value of contracts in relation to investments. If you can just recollect the disclosures we discussed in case of life insurance companies, most of these disclosures are same what we saw in case of life insurance companies. Yeah. So I'll just read out some more disclosures for the purposes of our understanding. Historical costs of the investments which have been valued on fair value basis. So they have been valued on fair value basis in the financial statements, but a disclosure of historical cost is required to be given. Any managerial remuneration, computation of that. Basis of amortization of debt securities, which would be there. Then another very important disclosure which is required to be captured over here is about the accounting policies. So what all accounting policies have been applied by this type of company, whether the accounting policies are in line with the requirements of the accounting standards, if there are any departures in terms of accounting followed by the company as compared to accounting policies which they would have specified as to the reasons for those departures. And we have discussed about the accounting policies, that all these accounting policies are very critical. All these accounting policies are integral part of the financial statements, because without the accounting policies, it's very difficult to obtain an understanding as to what the financial statements are really trying to convey. What has been the basis of the preparation of the financial statements. Then further, in addition to this, some more information is required to be disclosed. And once again, you will see that we had similar sort of points in case of life insurance companies. Investments made in accordance with any statutory requirement should be disclosed separately together with its amount, nature, security, special rights in and outside India. Segregation into performing or non-performing investments for the purposes of income recognition as per directions, if any, issued by the government. Percentage of business sector-wise. Summary of financial statements for the last 5 years. Accounting ratios. Basis of allocation of interest, dividend, rent. Another disclosure which should be given is about unclaimed amount to policyholders. If there are any unclaimed amounts towards the policyholders, then those amounts are also required to be disclosed along with their age as to why they have remained outstanding. Okay. Then the next part number 3 of the schedule B. Okay, so we are on to the schedule B, which in the first part captures the requirements related to accounting principles, which talks about the accounting principles. Then in the second part, it talks about certain disclosures. In the third part, it talks about the preparation of financial statements in the form of certain general instructions. Now, all of these accounting principles, first of all, we need to remember, should be very much in line with the requirements of the accounting standards. Okay, so that's why I'll not get into too much details of the general instructions. They are very much on the lines of accounting standards because this is what has been prescribed. So anyways, we can just understand that if the accounting standards are required to be applied with certain exceptions, then most of the requirements in terms of preparation of the financial statements would be as per the accounting standards only. Yeah. So if you talk about the financial statements preparation, and if you just try to go back to the requirements of the accounting standards, you would find most of them to be same. Yeah. For example, if we talk about income in the form of interest, dividend, rental, if you can see point number 3 over here. In connection with an investment, any interest, dividend, rental is required to be recognized and stated as gross value. If there is any TDS which has been deducted on that, and if there are any advanced taxes which have been paid on that. Yeah, these are required to be captured. Then it says the financial statements should not only cover the current reporting year figures, they should also give the comparatives. Yeah, for the purposes of the preparation of the financial statements, provision, reserves, all of these are required to be captured, and they have been covered as per the principles of accounting standards only. Yeah. Next area, which is once again required to be covered over here, is about the management report. Management report, if you remember, is all about putting the responsibility on the management. in respect of various requirements related to preparation of the financial statements. So it's all about responsibility related to financial reporting, which has been passed on to the management. So management needs to take the responsibility in respect of certain areas, specifically in the form of this report. When we say that the management has been given this responsibility, we also need to consider the fact that just by putting down these points, or to say that by putting down only these points, we are not trying to say anywhere that the entire financial reporting responsibility is not there with the management. It's there. But out of that complete financial reporting, there are certain areas over which management is specifically required to comment upon, which has been tried to be captured in this report. So if we look at some of the contents of this report once again, first, it talks about confirmation regarding the continued validity of registration granted by the authority. What's the authority? It's the ADA, okay, the relevant authority which basically regulates the insurance companies, that is ADA. Certification that all the dues payable to statutory authorities have been duly paid. Now, when we talk about this statutory authority, we are not limited to ADA. We are talking about any statutory authority. Confirmation to the fact that shareholding pattern, any transfer of shares during the year, are all in accordance with the statutory or regulatory requirements. Next, declaration that the management has not directly or indirectly invested outside India into the funds of the holders of policies issued in India. Confirmation that the required solvency margins have been maintained. Now here again, solvency ratios are required to be maintained, which has been prescribed by the relevant authority, by IDA or by any other authority. Now, confirmation to this effect by the management is required to be given, that all of these compliances, all of these internal requirements which are mandatory on the part of the company have been taken care of. Then, certification to the effect that values of all assets have been reviewed on the date of balance sheet. And that in his belief, that means belief of the insurer, that means the belief of the insurance company. Insurer means the insurance company. The assets which have been captured in the balance sheet, they do not exceed their realizable or market value, which could be under various headings. So all types of headings have been covered. It's required to comment that the assets are appearing at their realizable value or lower than that if they have been recorded at historical cost. So basically in this requirement, they have been specifically asked to comment if there was any sort of impairment. Because if the assets will be crossing their realizable value and still recorded in the financial statements, what would it mean? That there is some impairment problem. Yeah, the impairment testing is required or impairment provision is required, which may not have been done. So anyways, this requirement is required to be dealt with as per accounting standards. So that's why you need to remember the fact that if this company is required to follow all the accounting standards with certain exceptions, then any which ways all of these requirements, you can just always compare with the requirements of the accounting standards and comment upon that. And same is the responsibility of the management, because management also needs to ensure that all of these items which get recorded in the financial statements are as per accounting standards. Moving further on to some more contents of the management report. It requires disclosures with regard to overall risk exposure, strategy adopted to mitigate the same. Aging of claims indicating the trends in average claim settlement time during the preceding 5 years. Means how frequently, how quickly the claims have got settled. So all of these things are required to be commented upon by the management. Review of asset quality and performance of investment in terms of portfolio. This is again required to be captured. And this is required to be captured separately for the investments in real estate, investments in loans, or any other investments. Then, a responsibility statement is required to be given around the preparation of the financial statements. Around the preparation of the financial statements as per accounting standards, around the adoption of accounting policies and the selection of accounting policies, the basis of doing that, and whether the consistency has been ensured in terms of accounting policies which are in place, whether the management has taken care for maintaining adequate records of the books of accounts or in relation to the books of accounts which have been prescribed, and whether the management has been ensuring the assets of this company are safeguarded and there is a proper mechanism for detecting fraud and any sort of irregularity. Because all of these are the responsibility of whom? Management. Whether the management has prepared the financial statements on going concern basis. Once again, a very important area. The management has ensured that an internal audit system commensurate with the size and nature of the business exists and is also operating effectively. Okay. Yeah. Okay. Now moving further on to the next part in relation to general insurance companies. Now there are a few things which have been very specifically prescribed for them. General insurance company shall prepare revenue account, profit and loss account, balance sheet, and all of these accounts have been prescribed in terms of their format. Okay, and those formats are Form BRA, Form BPL, Form PL, and Form BBS. So all of these forms are what? Prescribed format of the balance sheet, P&L, revenue account. As we all understand that this revenue account is another account in case of insurance companies, which does not exist in case of companies other than insurance companies. Correct? Now, as regards the revenue account, this is required to be prepared separately for the different nature of insurance. That means if the general insurance company is into fire insurance, marine insurance, or say miscellaneous insurance, means other categories, then for all of these types of insurances, the revenue account is required to be prepared separately. Then an insurance company shall prepare separate receipts and payments accounts, and this shall be in accordance with the direct method which is prescribed under AS 3. Okay. Now Sumit is asking about the encumbrances. Encumbrances means it's a sort of lien, or you can say a charge which would have been created on any sort of assets of the company. Now moving on to the requirements related to audit. So all of these aspects that we have discussed so far were all in relation to the financial reporting. These were all in relation to the preparation of the financial statements of an insurance company. But for us, what is an important area? For us, the important area is all about audit, because we are currently looking at the audit requirements, and therefore in relation to the audit requirements, we'll have to pick up all of these items one by one. So the first area for audit, once again, we will pick up as premium. Premium we understand is the most critical component. Why? Because premium is nothing but the revenue of the insurance company. And same is the case in case of general insurance company. Premium is what? Which is the total revenue. Okay. So let's understand about this premium, and we will also check as to what is the procedure which the auditor would want to perform in respect of premium. Now, what is this premium? Premium, we can say, is the consideration received by the insurance company from the customer under an insurance contract, whereby the insurer, that means the insurance company, agrees to undertake the risk on behalf of the customer. Correct? For which, for taking up this risk of the customer, for taking up the risk of the customer, what is required to be done? Insurance premium is required to be paid. So let's understand how would this insurance premium be verified. What are the various procedures for verification of this insurance premium? Insurance premium is collected upon issuing policies, and it's basically the consideration for taking up the risk of the customer. Okay. Now, as an auditor, what's the first thing he can check? First thing he can check is about the number of the customers which the insurance company will have, and the amount of insurance premium in relation to that particular category which would have been earned by the insurance company during the year, or which would have been recognized by the insurance company during the year. Now, how can this be verified? This can be verified in two ways. One, that is the insurance premium which has been recognized, and second is about the insurance premium which has been received during the year. Now, we understand that the insurance premium is recognized on the basis of the terms of the insurance plan. So let's understand one very simple procedure which any auditor would want to perform. Okay, and I am once again not getting into the details of the control mechanism, planning, all of those procedures, as we have discussed about them. In case of life insurance companies, all of them will apply to this type of insurance company also. So we are discussing about insurance companies. So one of the procedures which the auditor can perform. Let's suppose the company has got various types of insurance, say fire, marine, and let's suppose others. Okay. Now let's suppose in case of fire insurance, the premium which they would have earned is, let's suppose, 5 crore. In case of marine, it's 2 crore, and in case of others, let's suppose it's 3 crore. So all in all, 10 crore is the premium. So the numbers are quite low, but for the purposes of our discussion only, I am taking these numbers. Now, first thing which the auditor can check is through some analytical procedures. So this is the total premium which has been recognized in the financial statements. Now the number of customers can be obtained from the systems. Let's suppose this is X, this is Y, this is Z. Now, on the basis of the number of customers, it can be checked as to what's the average premium. What's the average premium which has been charged during the year? Average premium which has been charged during the year. Now, if we look at this average may not really reflect any specific thing to the auditor, because we have once again taken a very broad category of fire insurance. Because under fire insurance, there can again be various types of plans which this company may be offering or which this company may have offered during the year. Yeah. So let's suppose there are various types of plans which this company would have offered during the number of plans. Now, in relation to all of these plans which the insurance company would have offered during the year, similar type of exercise can be done by the auditor. He can check as to what's the amount of premium which has been recognized under each category and what was the number of customers under each category. There again, it may become very complicated for the auditor. Why? Because if we look at one plan, or we can say one type of plan, let's suppose during the year, 6 types of plans were given under fire insurance. Within one type of plan, there can again be variations in terms of insurance premium, depending on the age, depending on the age. When I say age, so this is all about how old the material is, how susceptible that is to the fire. Okay, so there are a lot of factors which will go behind the assessment of this fire insurance. So that's why once again he will have to drill down to another level on the basis of which premium is derived. And all of these things, as you can see, are not very easy for the auditor to track if he will start doing all of these exercises manually. Yeah, so can you understand the challenge? First of all, we are talking about a large volume wherein multiple types of insurances are there. Within a type of insurance, there could be different types of plans, and within a particular type of plan, the insurance premium may vary depending on various factors. Now, for the auditor to check the insurance premium, one way could be that he can check the insurance policy document. Yeah. Let's suppose if the auditor checks the insurance policy document. So a company which would have thousands of customers, just by checking few policy documents, can the auditor obtain a comfort level on the premium income which would have been recognized? No. It's very difficult to do that. It's very difficult to do that. So that's why he needs to go beyond the sample testing. He needs to obtain a comfort level on this entire population. Yeah? Only when he will get the comfort over the entire population, he would be able to comment as around this item, whether it is misstated or not, or whether it is materially misstated or not. And for this, auditor would perform not only the sample testing procedure, but the controls assessment. Means in terms of recognizing this revenue, in terms of recording of this premium income, or in terms of derivation of this premium amount, what's been the process which has been followed? How strong are the controls of the company in terms of generation of these types of documents? Okay. Auditor would have to rely significantly on reports. Because as I told you, to do this exercise manually may become a very difficult task on the part of auditor. So that's why you will have to make use of the IT systems of the client. Only and only when he will be able to use the IT systems of the client, he will be able to get the desired output on the basis of which he can perform procedures. Okay. And this is, of course, over and above the sample testing, which will be a part of his substantive testing. There's no doubt that the sample testing would be performed by the auditor over here. He would definitely perform sample testing. But sample testing will only be one of the areas that he will like to do. It will not be the only area that he will be performing in respect of recognition of premium. Okay, clear on this part? Yeah. Now, similarly, there are various other procedures which the auditor may plan to perform in relation to premium. We can also look at some more procedures on the presentation. Let's understand all these one by one. First was all about the control assessment. So it says, before commencing the verification of premium income, auditor should look into internal controls, compliances which have been followed. He should broadly review the systems, very important factor. He should ascertain that all the cover notes in case of motor business relating to the risk assumed have been serially numbered for each class of business. So this is all about issuing the policy document. Once again, it's a control. Once again, it's a check to the systems that whenever any policy document is issued, whether that is getting issued in a sequential manner or not. Okay, so let's suppose if the policy issued is say 00001, then the next policy should be 00002 and so on. Next, auditor should examine whether the reinsurance, so wherever there is any sort of reinsurance, is not under a risk in respect of amount lying at credit and outstanding as at the year end. Further, auditor should verify the collections which are lodged by agents after the balance sheet date to see whether any collection pertains to risk commencing from the year under audit. So that means it's all about ensuring the cutoff. It's all about ensuring the completeness in relation to the premium which would have been recognized or which should have been recognized. Further, the auditor should check whether the premium registers have been maintained chronologically for each underwriting department, giving full particulars, including any sort of service tax charged, as per the acceptance advice on a daily basis. The auditor should verify whether the figures of premium mentioned in the register tally with those in the general ledger. So that means if there is a separate register which would have been maintained by the management in respect of premium, the auditor should ensure that whatever is flowing in that register is also getting recorded in the books. So there should be a proper reconciliation. It should not happen that some of the premiums which have been recorded in the premium register have not been booked, have not been taken to the books of accounts. Okay, so this match should be there. Auditor should verify whether the installments which are falling due on or before the balance sheet date, whether those are received or not. Okay, irrespective of the receipt, have been accounted for as a premium income as for the year under audit. Also examine whether installments of premium falling due in the subsequent year have not been recognized in the accounts as outstanding premium. So this is once again talking about the cutoff requirement, that the insurance premium of the particular year has got recorded in the current year itself, and this has not been shifted to next year, and any premium of the next year should not have been booked now. Okay. The auditor should verify transactions at the year end to check the amounts which are received during the year in respect of risk which is commencing or installments which are falling due on or after first day of the next financial year are not credited to the current financial year. So that means if the policy would have been given for the risk starting next financial year, but the premium has been received today. So the policy says that the risk will be covered starting from next financial year, but the customer has paid the premium amount today itself. So can that be recognized as revenue in the current year? No. Why? Because it belongs to the next year. So that's why its revenue should also get recorded in the next year. So once again, it is talking about the cutoff. Next, the auditor should verify the collections which are remitted by agents immediately after the cutoff date to verify the risk assumed during the year under audit on those collections. The auditor should verify whether GST has been charged from the customer at the rates which are in force on the total premium for all the cases of businesses other than those which are exempted from GST laws. Okay. Check whether GST so collected is disclosed under the current liabilities to the extent it's not deposited in the government's account. So the premium which is charged is subject to GST. So the auditor should ensure that GST has been recovered at the appropriate rate. And in case that has been received or that has been recognized, that is also appearing as a liability. Why? Because the GST amount is not really the income which the insurance company would have wanted. This is a pass-through. So this is collected from the customer and will get deposited to the government's account. Next, the auditor should also check that the money which is collected by the agents from the policyholders. Now this would be very, very common and very, very important area, because if you look at this insurance policy business, it's largely driven through agents. Agents are the one who bring the customers to the insurance company. And for bringing the customers to the insurance company, agents charge their commission. Okay. So now in this respect, what should the auditor ensure? Auditor should check that the money which is collected by the agents from the policyholders have been received by the company as quickly as possible. Let's suppose if the agent has got insurance of a client done, for which, let's suppose a check has been paid to the agent. So who is currently carrying the check? Check is in the possession of agent. So the check has been issued in the name of the insurance company, no doubt, but the check is with the agent. So any of such policies which have been issued through an agent, auditor should first of all check whether it's properly marked in the name of those agents so that their commission can also be appropriately computed. And if those have been marked in the name of the agent, whether the premium has been collected or not. And if the premium has not been collected, so whether the collection, whether the check for that premium is lying with the agent or not. And if that is lying with the agent, it should be collected as soon as possible. Yeah. Now, as regards its collection is not the responsibility of the auditor. Auditor has got nothing to do with the collection. Auditor just needs to ensure that for the policies which have been issued or for the policies which have been going out, if there are any such checks which are lying with the agents, those are subsequently received by the insurance company and appropriately recorded in the books of accounts. Okay. Next, The auditor should also check whether the bank guarantees against which policies are issued are valid, and there is a tracking mechanism of the amount of policies issued against the guarantee. So if there is any policy which has been issued against the guarantee, so that guarantee should also have been received. Those guarantees should remain valid up to the time the policy is in place. Okay. Next. So this was all about premium. Now we will move on to the next important component in the financial statements, and that is all about claims. You all understand claim? What is a claim? Yeah. So claim is no different in case of general insurance company. Claim is all same. The only difference is that now the person who would have taken the insurance would also be claiming this amount directly. Unlike the one which you used to see in case of life insurance, because in case of life, when there's a loss of life, so it's not the person who would have taken the insurance who would claim this amount. It will be his heirs, its legal heirs, his legal heirs. But in case of general insurance company, it will be the same set of persons who would be claiming this amount. Okay. Now, as regards the claims, we understand that claim is what? Claim is nothing but a cost to the insurance company. So let's now try to understand what are all the procedures which the auditor needs to perform in respect of claims. So let's move on to the audit procedures now related to the claims. First, in relation to the claims, the auditor should verify that the provision has been made. Now, this is on the aspect related to the accounting treatment, that the provision has been made for all unsettled claims as at the year end on the basis of claims which are lodged or communicated by the parties against the insurance company. The date of loss and not the date of communication thereof is important for recording or recognizing the claim as attributable to the particular year. So let's understand what are they trying to convey over here. So let's take this example. Say during this financial year 2021, okay, let's suppose an accident of the car took place because of which car got damaged, say on today, say on 22nd of March 2021. Let's suppose its claim is filed by the customer with the insurance company in the next financial year. When is the claim filed? Let's suppose on 2nd April, customer will file. Now in this case, the question that arises is, when should the provision be made? It's more of an accounting matter. But whatever is the accounting requirement, that also needs to be taken care of by the auditor. Because if the claim would be lodged in the financial year 21-22, the question arises whether this claim should be recorded in this financial year or this financial year. You may also think about it and let me know your answer. Now, as regards the claim, what is the period to which this claim belongs to? It belongs to this financial year. It pertains to this financial year. Even though this has not been submitted to the insurance company, this doesn't really go out to the insurance company in this financial year, but still it belongs to this financial year. So that's why if any such claim would have been received by the insurance company after 31st March, still, when is that required to be recorded? In this financial year. And this is something which the auditor needs to take care. And this is all about creation of provisions. Means ensuring that all the costs have been captured appropriately. All the costs have got recorded. So this is all about ensuring completeness in terms of recording of expenses. Yeah. And all of these accruals at the year end, which are required to be made, what becomes the basis for that? Estimates, or maybe the subsequent checking, or maybe the subsequent receipts in relation to that. So here again, we can see that even though subsequent to the year end, any claim has been received, still its provision should be made in this financial year only. Okay, clear? Next, moving further, we'll look at some more audit procedures. Auditor should ensure that the provision has been made for only such claims for which the company is legally liable, considering particularly that the risk was covered by the policy, if in force and the claims arose during the currency of the policy, claim did not arise during the period the company was not supposed to cover the risk, or where the checks covering the premium have been dishonored, or where a total loss under a policy has already been met or settled. The loss event or the nature of loss is not excluded from the policy coverage. The person who has incurred the loss is the policy holder. Okay. Now here again, it's all about ensuring that the provision has been made appropriately. Now, at times it may happen that the customer has lodged a claim, but he is not eligible for getting this amount for various reasons. Maybe the policy is already expired. Maybe he did not pay the premium on time, because of which his policy is no longer valid. Or maybe because of certain conditions in the policy, some type of claim which he has asked for was never allowed, never permitted. So in such a case, just by looking at any of these claims which are lodged, can a provision be made? No. So the provision should be made as per the terms of the policy document. But that's a contract between the two parties, the insurance company and the customer, and accordingly, auditor should ensure that any such expenditure which is getting recorded is in line with the terms of the policy. Next, auditor should ensure that in determining the amount of provisions, events after the balance sheet date have been considered. For example, claims which are settled for a materially higher or lower amount in the post-audit period, claims which are paid by other insurance companies during the year under audit and communicated to the company after the balance sheet date, where other companies are the leaders in co-insurance arrangements, and the further reports by surveyors or assessors, and reinsurance cover is available, and that has also been considered. Looking at some more procedures around the claims. In determining the amount of provision, the average clause has been applied. That the provision made is net of the payments made on account to the parties wherever such payments have been booked to claims. So if any of the payments have been made, those are also getting netted off. That wherever legal advice has been sought or the claim is under litigation, the provision is made according to the view of that legal advisor. And if there are any differences, those are explained. That in case of amounts which are purely in the nature of deposits with the courts or other authorities, adequate provision is also made for those. And the deposits are separately recorded as assets, and the provisions are not made in net of such deposits, because provision if has been made, provision if any that would have been made is required to be shown on a gross basis, and the deposits which would have been made to the court or to the authority during the period under which this litigation continues, so such deposit will continue to appear as an asset. Next, no contingent liability is carried in respect of any claim intimated in respect of policies which have been issued. That the claims are provided for net of estimated salvage. That the provision has been retained as at the year end in respect of guarantees given by the company to various courts for claims under litigation. That the due provision has been made in respect of claims lodged at any office of the company other than the one from where the policy was taken. For example, a vehicle which was insured at Mumbai having met with an accident at Chennai, necessitating claim intimation at one of the offices of the company at Chennai. Yeah, all of these requirements should be appropriately captured. Yeah. So these are some of the procedures which you can see in respect of claims. Now, next, and again, a very critical or very relevant area for an auditor will be about the commission. As we all understand that this insurance business is all based on the agents, very significantly. Yeah, because it's all about agents who bring the customers to the insurance company. So any of the commission or the brokerage which is paid to the agents is nothing but the cost of the insurance company. So let's look at what are the various audit procedures auditor can perform. First, ensuring that the commission or brokerage is not paid in excess of the prescribed limits by the regulatory authority. And who's the regulatory authority? It's AAPE, Insurance Regulatory Development Authority of India. Okay. So one is to ensure that the rates which have been passed on are all within the prescribed regulatory limits. Next, ensure that the commission or the brokerage is paid to the agent or the broker who has solicited the business. So it should not happen that the business has not been solicited through an agent or a broker, but still the commission is passed on to him. Or maybe it came from agent 1 and it's been passed on to agent 2. Okay, there could be such type of mistakes. Now this is something which the management needs to take care, and there must be a proper mechanism. And all of these things, as we discussed earlier, are not possible to be tracked manually. All of these things require significant controls, require systems to be maintained by the company, by the insurance company, basis which it's possible for the insurance company to track any of these requirements. Yeah, if the systems are not in place, then it may become a very, very difficult exercise on the part of the company to track it, because only through the systems it's possible to track it, considering the volumes into which they deal. Next, ensure that any agent or broker who is blacklisted is not getting paid, is not getting associated, and any agent who is blacklisted should not really be associated with the insurance company. Yeah, so it's all about looking at the KYC of the agents, and in terms of their KYC, ensuring that those are not debarred. If those have been barred by the regulatory authority in terms of getting into this type of business, then the insurance company should also not really be transacting through such type of agents. Next, check whether the vouchers are authorized by the officers in charge as per the rules in force, and income tax is also deducted. So this is all about TDS. So as regards the commission or the brokerage which should have been paid, this should also be approved. Internally it should be checked, its computation should be checked. Means what's the rate, what's the amount, what's the business which the agent brought in, what were the terms and conditions at which he was required to be paid. So all of these computations are required to be checked by the auditor. And this will not really be checked by the auditor on a test check basis. Auditor will generally be looking at this entire computation, and he may want to recompute it basis the understanding which would have found between the company and the agents generally. Secondly, when the payments have been made to them, then the TDS has also been deducted appropriately. TDS has been deducted, and the TDS has been deducted at the correct rates or the prescribed rates. Okay. Moving further, test check correctness of amounts of commission allowed. Test check correctness of amounts of commission which are allowed. Next, check whether commission outgo for the period under audit has been duly accounted for. So if there is any commission outgo, that is getting recorded in the correct accounting year. So this is once again about ensuring that the cutoff and completeness has been taken care of. Yeah. Okay, now moving further on to some more types of expenses in relation to the operations of the insurance business. And these are very much on the lines which we get to see in case of any other company, but still we'll just flip through all of these expenses one by one. In relation to legal and professional charges, as we discussed in case of life insurance companies, these types of charges are very important in this type of business. Considering the risk which is involved, considering the litigations which are involved, and considering the fact that the public involved or the dealing with public is too large, wherein all of these disputes keep coming up in terms of the amount which has been claimed, in terms of the amount which would have been paid. Yeah, so that's why focus of the auditor while checking all of these charges will not really be booking of the type of expense it is, but also be looking around all of those litigations which may be going on, but which are not really to the knowledge of the auditor. Yeah, so to track that, this is one of the mechanisms which the auditor can use. Next, employee remuneration and any sort of employee benefits. So these expenses can be verified on similar lines. So for employee compensation, I don't think there's any specific area that we need to discuss. So for employee compensation, all lot of procedures that you will apply for any other employee compensation, same set of procedures would be applied over here. So one is about checking the head count. Second is about checking the average salary payouts. These are in the form of analytical procedures. Then the substantive testing would be performed in terms of the population, the database of the employees, the internal controls which are in place in terms of their salary computations, wages computation, where the minimum levels which are required to be maintained in terms of the payouts to the employees have also been covered. Yeah. Next is about depreciation. So depreciation is again one area which will require recomputation procedure on the part of the auditor, because in terms of recomputation procedure, the depreciation computation which the management would have performed on the basis of fixed assets of the insurance company would be recomputed. It would be tested whether the lives of the fixed assets have been considered at the appropriate rates on the basis of lives, and whether those have also been reassessed in terms of the residual values of the fixed assets, whether those have been considered at the appropriate level. Yeah. Any of the additions or deletions have also been captured appropriately. Depreciation has been computed on a proportionate basis. So all of those procedures which you will see for any other company will also apply over here. Similarly, interest expense or the rent expense, or we can say interest income or the rent income or the dividend income, those are all very much on the same lines that we will get to see in case of any other company. So that's why I'm not getting into too much details around it. Okay. Now moving further on to the cash and bank balances. Now on cash and bank balances, once again, this is not really, I would say, an area which will have some peculiarities, but considering the nature of business, the insurance company is into, the volumes of transactions are huge, and that's why the cash and bank balances volumes you will also get to see at a very significant level. So let's understand what's the procedure which an auditor can perform in relation to cash and bank balances. Just give me 1 minute. In relation to cash and bank balances, you can just quickly read these points. Okay, now on the cash and bank balances, what's the first procedure which is important? Bank reconciliations. Testing of the bank reconciliations. As around the cash, the physical verification of the cash. So these are couple of procedures which we can say are very important and relevant in the context of the nature of item. And in relation to an insurance company, these are no different from any other item. The only thing is that in case of an insurance company, you will get to see various type of transactions taking place. Voluminous transactions would be there because the number of customers would be huge. So the collections would be numerous throughout the year. And wherein the reconciliations may also be very, very significant in terms of the volume. But that's why this area will also become a very important area for the auditor. And any which ways we understand that cash and bank balances in case of any audit is considered to be of significant importance. So same is the case over here. Okay. Next is about ensuring that the taxes, etc., which have been which have been recognized in the books of accounts have been done at the appropriate rate. So when we talk about the taxes, etc., so it's all about the provision for the direct tax, whether the provisions for the direct tax have been made appropriately, and there are no disconnects, there are no gaps in terms of creation of provisions of any sort of direct tax. Another important area which the auditor should assess is about the solvency margin. So if we move further, if you remember, there was one solvency margin that we discussed, which the insurance companies are required to maintain. So what is the solvency margin? Every insurer is required to maintain an excess of the assets over the amount of liabilities at all times, which shall not be less than 50% of the amount of minimum capital as stated under section 6 of the relevant act and arrived at in the manner which is specified by the regulation. So there is again a way to compute this. For us, I don't think we need to get into too much technicality of computing this solvency margin. We need to understand what are the audit procedures which are required to be performed. So if you look at the financial statements of an insurance company, there's one area that is about going concern assumption. Yeah. Any company is assumed that it's ongoing concern basis. And if it's not ongoing concern basis, then the way its financial statements are prepared are significantly different from the way they are otherwise required to be prepared. In case the financial statements are prepared on a going concern basis or not, auditor needs to ensure that the going concern assumption remains valid. And this is considered to be an important area for the purposes of audit. And the same thing we need to understand over here. Now, if you look at the regulatory requirements, considering the liabilities to which any insurance company will be subject to at every point of time, in simple terms, we can understand that an insurance company is required to ensure that at every point of time, its assets are, or you can say the value of the assets over the amount of liabilities at every point of time shall not be less than 50% of the amount of minimum capital. Okay. So basically twice the amount. And why this has been done? To ensure that the liabilities can be paid off at every point of time. To ensure or to check that insurance company is solvent at every point of time, basis which it will be able to pay off this liability or pay off any type of liability which may arise in relation to the customers. Yeah. Therefore, it becomes important on the part of the auditor to ensure that such solvency ratios are maintained by the insurance company. If the solvency ratios are not maintained, let's suppose it should not be less than 50%. Let's suppose it goes below 50%. Let's suppose it becomes 49%. So we can say definitely it's breaching the requirement of the relevant act. Definitely the solvency margins are not up to the mark, are not at the desired levels. But will that really trigger the going concern assumption? The answer may be no. Because just by 1%, the solvency ratios have got impacted, but that 1% may not be the percentage basis which going concern of an insurance company get challenged. Okay, but yes, this is for sure that if the solvency ratio remains impacted, means it's not at the desired level for a significant period of time, and this is how that this generally behaves throughout the year, then this may be an area of concern for the auditor, which may also have certain reporting implications on the part of the auditor in his audit report. Okay, clear? Clear on this part? So now, similar to this, there are various other items for which we have already talked about whole lot of audit procedures. And now what we will do is we will pick up some examples. Okay. On the basis of our discussion so far, we will pick up some examples wherein we'll apply some of these requirements that we have understood so far. Okay. So I'll move on to the examples now. And you need to just make sure that you remember all the provisions that we have discussed about insurance companies. If you remember, we talked about a lot of requirements related to the insurance companies. So some of those requirements may also start flowing in these examples. So let me just move on to an example which will capture all of these requirements. Okay, so let's suppose there's an insurance company, say ABC Insurance Company Limited. It's an Indian company. It's an Indian company wherein the percentage shareholding is all through Indian shareholders. Okay. This company has been into existence, let's suppose, for last 8 to 9 years. 8 to 9 years. And the company has been going on through some financial turbulences, so that's why they need some funding. They are thinking of bringing some funding, and for the purposes of funding, they are planning to bring in foreign investors. And they are thinking that they can bring in the foreign investors by having foreign investors holding 55%. So foreign investors holding 55% share. So this is only a plan. So nothing is finalized. This is only a plan. So they are also planning to go in for approvals. Okay, or all of these procedures which are required to be found, they are all thinking about it. Okay, so this is only a plan. Nothing has been finalized as yet, but yes, internal discussions have taken place, and board of directors of the company are also considering this. Now, as around this company in terms of the financial statements, in terms of the requirements of the financial statements, there are few things which need consideration. Number one, the financial statements do not contain any component which is in the nature of interest income. Okay, so there's nothing in the nature of interest income in the financial statements. Considering the fact that interest income is not allowed to be recognized by any insurance company. Okay, this is what the management has understood, and all of such interest income has been captured under premium. This company doesn't have any interest income anyways year on year. It's not significant. Even if it arises, that is recorded under premium, because this component cannot be there in the financial statement. So that's the understanding which they have, and this has been continuing for years now. Auditor also didn't object to this during any of the years, but during the last year, when a new auditor came on board, it was challenged. Okay, so the new auditors said that such interest income should not get clubbed with premium, irrespective of whether it's significant or insignificant. It should not get clubbed with premium income. Now, the management has an assessment, and management has a couple of reasons to counter this. Management is saying, first of all, it's not something new. This has been going on for years. Secondly, this amount is also insignificant. This is not material. So there's no point changing the practices which the management would have followed over the years. Management is also planning to consult around this matter as around the presentation of all of these items in the financial statements. Okay. Now, considering these two, you are required to comment on these two areas. You are required to comment on these two areas. So I'll just say option number A. As regards the foreign funding, management should go ahead with this, because it's all about getting into expansion mode. Even though they are facing some problems, but still through this funding they will only be able to expand. So foreign funding they should follow. Secondly, as regards this interest income, there is absolutely no problem in this. So this should also continue. Option number 2. You can start getting into these options. Please start analyzing it, and you can start answering around all of these options one by one. Okay. Option number 2. This foreign funding is not the right way to resolve any of these problems. Though this is allowed, but still it's not the right way. Instead of this, insurance company should get into borrowings. Okay, so they should have client funds, because it's a regulated business. Government will also be focused towards it. They will be getting the funds at a lower rates of interest. So that's why it's not advisable. Okay, even though it's allowed, but not advisable. So we are saying allowed, but not advised. And as regards this interest income, this is definitely a wrong practice which seems to have been followed in past years. This should be discontinued. This should be discontinued, irrespective of whether it is material or immaterial. It's all about getting into the principles. Number 3, as around the foreign funding, this is not allowed. So that's why some other option needs to be evaluated. Some other option is required to be evaluated. Some other option needs to be evaluated. And as regards this interest income, considering the fact this is immaterial, this can be ignored by the auditor, but it's a practice which the company has been following year on year and which really cannot continue. And even if this is immaterial, this is not something which can get clubbed with the premium income, which appears to be the revenue. So that's why this interest income recognition should stop in terms of getting its classification. So option number D. As regards this foreign funding, we can say it's okay and absolutely not a problem. Yeah, so it's very much on the same lines of option number A. And as regards this interest income presentation, this is not permitted for an insurance company. Okay, insurance companies are not permitted to have any sort of interest income. So they should ideally not be having any interest income in place. But in case they have, then it's not a choice. It's not a choice available to the management to present it anywhere. They have no option but to do this. But at the same time, yeah. So if they are presenting it under premium, they can do this, but a disclosure should be given. But disclosure should be given. If the disclosure is given, then it can continue. Yeah. So this practice can continue with the disclosure around it. So Chavi wants to go with option number C. Quickly, all of you, what is your option? So Chavi has opted for option number C. So let's analyze all of these options one by one. Yeah. Okay. So now first option, which says foreign funding is permitted, which is not correct. It's capped up to 49%. So that's why this option becomes incorrect. And the moment we say it's incorrect, option number D also becomes incorrect. So that means option number A and D go off. These two options are not possible. Now the choice has to be made between option number B and C. In fact, option number B also says that foreign funding is allowed, but it is not advised, which is again not true. Can we say it's allowed? No. So that means option number B also goes on. So we are left with only option number C. Sumit said, so it should be option number D. Sumit, I am sure you must have understood why it should not be option number D. Sankalp went with option number B. I'm hoping, Sankalp, you are now clear as to why option number B is not possible. But we will also check whether the option which is selected by Chavi is correct or not. maybe all the options are wrong in this. Let's understand. Foreign funding is not allowed is correct, but some other option needs to be selected. That's the only choices available. As regards the interest income, in terms of the practice which has been followed to show this interest income under premium is incorrect. Number two, to say that interest income cannot be recognized by an insurance company is again an incorrect thing. So it's a very, very basic thing. Can there be any such type of restriction on any type of the company in terms of generating the interest income? Let's suppose if they've got bank deposits, will they be generating the income on that or not? Yes, of course, they will be doing that. Yeah, clear? So that's why all of these options will finally be coming down to option number C, which is the correct option. Okay, clear on this? On option number D, sorry, on option number C. So option number C is the right option. Now, what we can do is we can take a break, and after the break, we will continue with our discussion in relation to insurance companies. We'll also pick up some more examples based on the discussion we have had so far in terms of various requirements related to insurance companies. Okay. And then we are also left with a small part of insurance company, which we'll cover in the second part. Okay. So let's take a break. In the meantime, if you have any questions, any queries, you may just let me know. Jay. 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 Hi, welcome back. So we'll now continue with our discussion. So looking at one more example now. Okay, now for an audit firm, which is say ABC Company LLP. ABC Company LLP. So it's an audit firm. Huh? Now this audit firm has got significant experience. We can say it's around 20 years old CA firm, which has been into practice and has got significant experience in terms of statutory audit. Okay, significant experience of statutory audit, wherein whole lot of areas have been captured. PSUs, they have audited significantly. They have audited banks. They have also audited insurance companies in the past significantly. Even currently, if we look at it, so their portfolio comprises of various companies which are under these. Secondly, they have not been auditing private limited companies. They have not been auditing private limited companies for some reason. Okay, for some reason they have not been auditing private limited companies, and we can say for the last 5 years. Maybe they don't want to pick up the small private limited companies. They want to focus only on the listed in terms of this we can also see listed companies they have been auditing. So maybe they don't really want to get into these audit of small companies. Yeah. So this has been their portfolio. This has been their work which they have been doing over the years. In terms of the size of the firm, they are quite big. They have got number of offices. We can say they have got 5 to 6 offices across India, and they have got 7 to 8 partners. Okay, and their head office happens to be Chennai. Chennai happens to be their head office. Yeah, so this is how they have been spread and they have been carrying out their operations. Now, for this CA firm, for this LLP, a question has arisen as around the audit of the insurance companies. Audit of the insurance companies for the financial year 2020-21. So the question is all about the number of insurance companies which this firm can audit, and the question is about the type of insurance companies which this firm can audit. Okay, so the first option number one. Option number one is the general understanding which we have for any other CA firm, that a CA firm can audit only three. So they can audit only three insurance companies. Secondly, as regards the type, not more than two life or two general. So we can say capped to two life and two general. So this is the first option. Option number A. Another option. Option number B, considering that it's not a partnership firm, it's an LLP. Number one. Considering this is an LLP, this being LLP, and the fact that its portfolio does not contain any private limited company, and its current portfolio does not include private limited company. The number of insurance companies which it can audit will be 4, wherein 2 can be life and 2 can be general. 2 life and 2 general. Okay. Option number 3. Considering that the current scenario which has been going on. Okay, so if you look at this financial year 2021, for which the appointment would have taken place in 2020. Appointment would have taken place in 2020. Yeah, which is a period of Corona. So during Corona period, appointment would have been made. Appointment would have been made, and because of which there's no limit on audit of insurance companies or not. Okay. There are exemptions. There are exemptions due to Corona which are available. And the same thing applies to these types of firms also, for insurance companies also, because it's very difficult to find the auditors during this period. And it's very difficult to put down such limitations, such restrictions. Otherwise, the audit will not get completed. Okay, so that's why they are free to do any number of audit and any type of insurance company within that limit. Option number 4. Option number 4 is considering the number of offices which they have, considering the number of partners which they have. Yeah, I'm saying considering the number of offices. On the basis of number of offices, partners and their specialization. Okay, they also have got specialization. Why? Because they have been auditing PSUs, they have been auditing insurance companies, they have not been auditing private limited companies. They have experience of auditing large size companies for the last 20 years, or at least for the last 5 years when they have stopped auditing private limited companies. They are free to audit any number of insurance companies. So we can say no capping. There's no capping. However, because their office, their head office is at Chennai, so that's why only the insurance companies which they can audit in terms of not getting covered into the capping will be the one which have got their corporate offices in the southern region. Okay, so I'm saying only insurance companies having corporate office in southern region. Sorry, I have not been able to write it, but I hope you understand this requirement. Huh? Okay, so now out of these options A, B, C, and D, which one do you think should be the right one? Out of these 4 options, A, B, C, and D, which one will you choose? Quickly, if you can get on to the option. Sankalp is going with option number A, and we can also pick up all of these options one by one. I think this is again a very, very simple question for all of you to answer. Correct? So I'll just move on to this. So let's get on to these options one by one. Chavi is also going with option number A. Now, when we discussed about the capping in terms of the number of audits for an insurance company, we discussed one principle, that the number of audits of an insurance company which an auditor can audit is 3. That was 3. And we further discussed that out of these 3 insurance companies, maximum 2 can be into life insurance and maximum 2 can be into general insurance. So it has to be 2 plus 1. Yeah. We never discussed anything about any exemption related to Corona. We never discussed anything due to which this limit may be changed or may be increased for companies which are LLP or large sized, or which will have only public limited companies in their portfolio, or any such exemption coming in because of the number of offices. In fact, we didn't discuss any exemption at all. Is that correct? Yeah. So when we never discussed it, it does not exist. So we don't need to consider any of those exemptions now. So all of those exemptions, therefore, are irrelevant for us. So for us, what's the right answer? A option would be the right answer. So you should not get confused with any of these exemptions or any of these things which get added to the options. Clear? Yeah. Okay. So now, before we move on to some more examples, we can move on to the last part of this chapter, that is about auditor's report. A very simple area, but as we understand, the most important area in case of any audit. Okay, moving on to the auditor's report now. So if we look at the ADA regulations, it talks about Schedule C. You remember Schedule A, that was for life insurance companies, Schedule B, that was for general insurance companies, and then there was Schedule C, which applied to both the types of companies, but which was all about reporting by the auditor. So this Schedule C talks about reporting by the auditors. So let's understand what are the requirements related to this. What is it that the auditors need to report on? First, that they have obtained all the information, all the explanations for the purposes of their audit. That the proper books of accounts have been maintained for the purposes of their examination. All of these things you will be thinking, but sir, any auditor would cover this. Yes, that's true. It's just that all of these requirements have been laid out over here. Next, whether proper returns, audited or unaudited, whether proper returns, audited or unaudited from branches and other offices have been received, and whether they were adequate for the purposes of audit or not. Okay. Next, whether the balance sheet, revenue account, P&L, those have been dealt with by the report, and the receipts and payment accounts are in agreement with the books of accounts. So whole lot of requirements which are arising from the set of the financial statements. That means the one which is covering the balance sheet, the one which is covering the revenue account, the one which is covering the receipt and payment account, they should all be in agreement. Okay, they should all be consistent. So the information which is flowing into the revenue account should be consistent with the remaining set of the financial statements, and they should all be going in line with the books of accounts. Okay, just give me 1 minute. Next, whether the actuarial valuation of liabilities is duly certified by the appointed actuary, including to the effect that the assumptions for such valuation are in accordance with the guidelines and the norms, if any, issued by the relevant authority and the Actuarial Society of India in concurrence with the authority. Now, one thing which we discussed in the last session was about actuarial valuation. And we also understood that actuarial valuation happens to be one of the most important area for the purposes of audit of financial statements of an insurance company. Because a significant portion of the financial statements in terms of the revenue which is getting recognized is getting generated from this actuarial valuation. This valuation impacts significantly the premium. So that's why auditor is specifically required to capture this aspect. Okay, auditor is therefore required to specifically capture this aspect. Yeah. Next is about expressing an opinion. So what is it that he will do? He will talk about the balance sheet in terms of the statement of affairs. Then he will talk about the P&L in terms of the financial performance of the entity. Then he will talk about the revenue account in terms of surplus or deficit, if there is any. He will talk about the receipts and payments in terms of the receipts or payments of the insurance company. Yeah. So all of these items will be covered by the auditor. Next, the financial statements which are stated above are prepared in accordance with the requirements of the regulations. They are prepared in accordance with the regulations and the Companies Act. So any of the requirements, any of the regulatory requirements, those have been taken care of. Next, investments have been valued in accordance with the provisions of the Act. Investments, again, a very important area in case of insurance companies. So their valuation is something on which the auditor is required to comment upon. Accounting policies are appropriate and in compliance with accounting standards. Auditors shall further certify they have reviewed the management report and there is no apparent mistake or material inconsistency with the financial statements. If you remember, when we discussed auditor's report, remember auditor's report, the essay on auditor's report that we discussed? Therein, the auditor was required to ensure consistency with the information of financial statements and the information which is forming part of annual report other than financial statements. So this is similar point. Here again, we have got one management report which may contain some data, which may contain some information, which is also reported in the financial statements. So auditor has been put on this responsibility. He needs to certify that there is no apparent mistake or material inconsistency in relation to both these types of information. Next, he is also required to certify that insurance company has complied with terms and conditions of registration. Okay, so the regulatory compliances is once again an area on which he needs to give his certificate on. A certificate signed by the auditors, which is in addition to any other certificate or report which is required by the law to be given with respect to the balance sheet, certifying that they have verified the cash balances and securities relating to insurers' loans, reversions, and the life interests in case of life insurers and the investments. So they are specifically required to provide this certificate in respect of cash balances, securities, and the life interests and the investments. The extent, if any, to which they have verified the investments and transactions related to any trust, if there are any trusts undertaken by the insurance company as trustee, and no part of the assets of the policyholders' funds has been directly or indirectly applied in contravention of the provisions of Insurance Act relating to application and investments of policyholders' funds. Okay, so this is another area on which auditor is required to comment upon. Now, from all of these points, you must have understood that auditor's reporting is not really limited to the financial statements over here. It goes beyond the financial statements. Over and above the audit of the financial statements, auditor is also required to certify various other requirements which are specific, or you can say which are very peculiar to the insurance company or to the business of the insurance company. Correct? Yeah. So all of these requirements are therefore considered to be importantly considered during the course of an audit, because if during the course of an audit, auditor will be looking around any information, he would also be required to ensure consistency. Yeah, because all of these information is going to be audited or kind of certified by him. So that's why during the course of his audit itself, he will be looking at all of such items. Okay, clear? Clear on this part? Next, now once the audit reporting is completed, so let's understand around the signatures reports to be attached with the accounts and statements. Accounts and statements which are referred to in subsection 1 should be signed in case of a company by the chairman, if any, and the 2 directors and the principal officer of the company. It further provides that accounts and statements should be accompanied by a statement containing the names, descriptions, occupations of, and the directorships held by the persons in charge of the management of the business during the period to which such statement refers, and by a report on the affairs of the business during that period. Okay, clear on this? Yeah. So with this, we come to an end to our discussion on the insurance companies and on the audit of insurance companies. As around audit of insurance companies, you would have understood that principally the audit requirements have not changed. The basic audit process has not changed, but definitely there are various regulatory requirements which are different in case of an insurance company. The nature of business of an insurance company is different, and because of which the requirements related to audit may also change, and which is no different from any company. Depending on the nature of the business, audit procedure would change anywhere. Correct? Yeah. So same is the thing which you are also required to consider. All right. So we can now end our discussion related to insurance companies, and we can now start with a new topic. If you have any questions, any doubts related to this, you will let me know. And we are now moving on to the next chapter. Okay. Just give me 1 minute. I will move on to the next chapter now. So we are now starting with due diligence, investigation, and forensic audit. And in respect of this part, we will now be starting with due diligence. Okay, so it's about due diligence now. Okay, so let's try to understand about due diligence first of all. So what is this due diligence? And what are the requirements related to due diligence? How is this really relevant for us? And most importantly, how is this due diligence different from audit? Because all through we have been discussing about audit. Then what's the role of anybody who is carrying out due diligence when an audit is being performed? Okay, So all of these things we will now understand during the course of our discussion under due diligence. Okay, so now moving on to the meaning of due diligence. So what is a due diligence? See, for an audit, we say that when an audit is conducted, so we conduct an examination of books of accounts, correct? And what's the purpose of an audit? To express an opinion on the financial statements. What's the purpose of audit? To express an opinion on the financial statements. So that is something which we get to see in case of audit. And let's understand about due diligence now. In case of due diligence, once again, an examination is required to be done. So it will also involve examination, or we can say verification, or we can say testing, or we can say any other procedure. Yeah. Similar to what you see in case of an audit, right? This is again similar to what we see in case of an audit, which is also performed in case of a due diligence. So a whole lot of procedures which are required to be performed in case of an audit are also performed in case of a due diligence. But there are few things which are different in case of a due diligence as compared to audit. So for which we should first of all understand about due diligence briefly, and then we'll come back to compare this with audit, and then we'll get on to the details. So what is a due diligence? Due diligence, you can say, is again an examination of an area, which is performed for a specific purpose. For example, let's suppose there's an investor who wants to acquire a company. So there's an investor who wants to acquire a company. So this is not a new company. This company has been into operations for quite long. Let's suppose this is 10-year-old company. This company is quite old, and this company has been carrying out its operations. This company may or may not be generating profits. Currently, the investor is thinking to buy out this company. The plan is to acquire this company. Okay. Now, we understand that this being a company, its audit should have been performed. So this being a 10-year-old company, year on year, its statutory audit would have been performed. Correct? Tax audit may also have been performed. If this was applicable, GST audit may also have been performed on this company. Yeah. Or any other type of audit which may be applicable on this company would have also got performed. So we are saying all the statutory audits were performed. And let's suppose the reports of all the audits have been cleaned. So we are saying all the reports have been cleaned. Okay. Now, when this investor wants to buy this company, what are the areas which this investor would really want to get into or would really want to focus into to buy this company. So let's think about those areas. So one area which this investor can consider could be synergies. Maybe this company is into a business which investor is already doing. And by acquiring this company, there will be benefits, synergies. Investor wants to expand within the same line of business. Expansion is what he is targeting. Or you can say to cut the competition. Maybe this company was into competition, so to cut the competition, investor wants to buy out. Now these could be various purposes. Now for any of these purposes or maybe for any other purposes, what are the considerations which the investor will have? One, and the most important will be the financial performance of this entity, and which may be current or expected. This may be current or expected. Expected means the future performance of the entity or this company. Maybe its current performance is not up to the level, but the potential is huge. The potential is huge, and which this investor really wants to focus on. And that's why he is targeting to buy this company. Okay. Number one area. Number two, if there are any sort of liabilities which are attached to this business. When the investor will buy this company, what will happen? Any of the hidden liabilities which this company may not have recorded in its books of accounts, any of the contingent liabilities which may not be which may not be recognized in the financial statements, which may only be disclosed, and which the company was not sure of whether they will actually get materialized or not. They may come up in future. Any of the litigations which may be going against the company, all of those litigations may also result in a future liability. Okay. So various litigations which may result in future liabilities. So this is another area which the investor would want to focus on. Yeah. Number three would be the legal compliances. For a company, legal compliances is another very important area. Non-compliances of a company would not only result into a financial penalty, but that may also impact the reputation of the investor in the future when any such non-compliance comes into the picture. So maybe there are certain non-compliances today which this company may have done, but which are not known. And at future point of time, they may become known to the investor. And those may come up. And those may not only result in financial penalty, but that may significantly impact the operations of this company. Okay. Maybe the company has been carrying on the business without obtaining the required licenses. So what can happen? This can impact the very functioning of the company. So the very existence of the company may get therefore challenged. So that's why some of these legal compliances may be very, very significant, may be very, very important on the part of the investor to analyze. Correct? Yeah. So this is another area which an investor would always want to look at, would always want to consider before buying out any company. Yeah. Next is about the costs which are associated with this company. Next is about the costs which are associated with this company. Some of the companies may be incurring the costs which may not really be required. For example, they may be very heavy in terms of the employee base. Maybe the number of employees which they have is not really required. Yeah. Maybe the top level management which they have is not really competent to carry on the business, or maybe the employee base which this company may have is not that competent which this investor would like them to have. So this is all about not only the costs which are related to the employees, but similarly there could be various other costs which may be attached to that company and which may not really be required or which may not really be continued and which this investor may want to look at. Okay. Now considering all of these scenarios, another very important area which arises is the fact that whether all of these factors would have been taken care of by this company in the past. Whether all of these reportings would have been made by any of these auditors in their financial statements in the past, or whether the financial statements, even though those are audited, are getting reflected in the right manner, the way they should. When you look at the audit of the financial statements, it focuses on material items. And the audit particularly focuses on financial factors. If a company has got employees who are incompetent, or let's suppose they've got number of employees who are in excess of what they are required, will that be of any concern to any of these auditors? Not at all. Why? Because that's the concern of the management. That's one area which the management needs to look at. That's not really the thing on which the stat auditor would want to focus on. That is none of the areas for the stat auditor to focus on. But should that be an important item for the investor who is wanting to buy this company? Yes. So will that get reflected anywhere in the reports of the auditors? No. There could be certain problems in the financial reporting which may not be crossing the materiality threshold of the auditor, but which may again be very, very important on the part of the investor. Correct? Yeah. And most importantly, there could be various factors which are non-financial in nature and for which there is no separate report available. So for doing all of these assessments, another type of verification is performed, and which happens to be a more in-depth analysis of the business or of a particular area of a company, that is called as due diligence. Yeah. So due diligence, we can say, is a more in-depth analysis as compared to what is done in case of an audit. And this not only focuses on the financial factors, this not only focuses on the financial items, this focuses on any area, any item which is required by the investor. And due diligence, therefore, does not arise out of any statutory requirement. So there is no statute which mandates due diligence to be performed. No. Yeah, so there is no legal requirement as around this due diligence. This is something which the investor would want to do for the purposes of getting a comfort as around this company which is targeted to be bought. So this company which the investor is targeting to buy is what he wants to focus on. Yeah, that is where he would want this due diligence to be carried out. Okay, clear on this? Now there are few terms for this due diligence which we need to remember throughout the course of our discussion. In a due diligence, the company which is under consideration to be bought is known as target. So this company is called as target. Target means this is the company which is targeted by the investor. Okay, so whenever we use the term target, target means the company which is under consideration for buyout by the investor. Okay. Next, this entire process of due diligence would generally be done, would generally be performed before the deal is through. So it's a sort of deal which is going on. Between whom? It's a deal between the shareholders of this company. It's a deal between the shareholders of this company and the investor. Yeah, so they have a deal, they are entering into a deal, they are entering into a contract, or they are planning into a contract. They are planning to enter into a contract wherein the shareholders of this company would sell the shares to this investor. So the sale of shares of this company by the shareholders could be full or could be partial. So maybe only 20% of the shares are sold, maybe only 10% of the shares are sold, or maybe 100% of the shares are sold. It could be anything. It could be anything. It really doesn't matter. What matters is that this process investor would want to complete before this deal gets through. Deal gets through means before he has finally acquired this. Because otherwise it will be not of much use to the investor. Because let's suppose if the investor has finalized everything with the shareholders, deal is also through, agreement is also finalized, and the payment, etc., everything has been made. Now the investor has come on board. And that is when he wants to do this process. Will that be of any use? No, because he is already on board. So even if he gets to know about any of the problems which may have impacted his decision, will he be able to change that? No. However, as regards this process, this is considered to be a very critical activity for the investor. Why? Because money is at stake. Investor is going to spend a huge amount of money. Please understand that all of these acquisitions are not really done for few lakhs. They would generally be running into crores or hundreds of crores at times. And to set a deal is not an easy process. It takes a lot of time, lot of discussions, lot of deliberations take place, on the basis of which any deal will get through. Yeah, so that's why a very stringent assessment is required to be done by the consultant or by this party who will be doing the due diligence. Now, on the basis of this due diligence which will be performed, it's not necessary. It's not necessary that the report of this due diligence will be to the satisfaction of the investor. Correct? Yes or no? Yeah. So another thing which we may find is that investor is planning to acquire. The deal is in process, and this due diligence report. Okay. So the report of the due diligence which has been given by the consultant to the investor is not to the satisfaction of the investor. Means what all things investor had thought about this company are not there. So his decision is impacted in a way that he doesn't want to invest this company now after looking at this report. Yeah. Now let's understand the consequence of this. Let's understand the importance of this report now. Because of this report, one keen investor, so there was an investor who was keen to invest in this company, has lost his interest, or maybe has changed his decision. Secondly, the shareholders of this company, or you can say the sellers, yeah, they were expecting a significant amount of money through the sale of this company, or maybe they wanted, or maybe let's suppose the intent of the seller was what? That they will sell 50% of their shares, and through which funding will come into the company, through which they will get the funding in the company, and through which they can also expand the business. They will also expand the business of the company, and which is no longer there, and which cannot really happen. So can you understand the importance of this report? How important this report will be for both the parties? Yeah. So can you understand the importance of this report now? How important this report is going to be for both the parties? Yeah. Now, considering the importance of this report, a lot of focus is placed by both the parties into this due diligence process. And it's very, very important that when this due diligence process is being carried out, support is made available to the consultant who is carrying out this due diligence exercise. Support is given to the consultant who is carrying out this due diligence exercise. It's very, very important. Okay, support from the seller side, because when the consultant will be carrying out the due diligence process, consultant would require a whole lot of information from the company about the understanding, about the business, about with records, various information in relation to the specify as to what area he is really looking at, on which the consultant needs to focus on. And accordingly, the procedures under due diligence will be required to be performed by the consultant. Okay, clear on this? So with this, I have broadly covered the areas or the perspective about this due diligence. Now, as around this due diligence, we will now get into more details. We will understand as to what all types of due diligences are there, what all procedures and areas are really required to be focused on, and what is the outcome of the due diligence report and how that is addressed by the investor. Okay, so moving on to due diligence now in terms of the types that we have. Sumit is asking, so due diligence is mandatory for conducting any audit? No. First of all, there is no linkage between audit and of the company or of the target without getting into an in-depth analysis. And for doing this in-depth analysis, a process which is required to be performed is called as due diligence. Okay, and I'm hoping that you would have understood the importance of this due diligence. Correct? Yeah. Okay. Now let's move on to the types of due diligence. And on the basis of the types of due diligence, procedures which can be performed and which will automatically come to your mind. First, and very common due diligence is called as financial due diligence. Very common, very popular due diligence which is required to be performed, that is called as financial due diligence. It's all about getting into the financial information. Now, in terms of the financial information, we are not saying it's limited to the financial statements. It's about the financial information. Maybe it's focused on revenues. Maybe it's focused on the costs. Maybe it's focused on complete finances. Maybe it's focused on the consultant will be on the taxation part. It's about the applicability of various tax laws on the company, about compliances in relation to all of those taxation requirements. Now, in relation to tax diligence, this would generally be covering all types of taxes, means the direct taxes as well as indirect taxes, and their impact on the business, their impact on the financial information. Generally, when the financial diligence is performed, tax will also be one of the areas, or you can say part of the financial due diligence, but at times this may also be separately be required depending on the importance of this area. So let's talk about some of the companies which avail significant deductions or which are subject to deductions under income tax. They enjoy tax holidays. Now, for these companies to assess the applicability of all of such taxation holidays or all of such taxation reliefs in respect of those companies, or how those could really be built upon further, maybe by setting up a particular business venture into a particular location or with a particular infrastructure or with certain compliances, how all of those tax benefits could be availed is the area of focus in case of tax diligence. Okay. Next, and again a very commonly performed diligence happens to be the legal one. The legal diligence. See, this is again of its operations, of its financial performance, of its financial statements is required to be performed. And when we talk about this legal due diligence, we are not limited to financial statements. It may be covering around any legal compliances. Let's suppose for a company, obtaining a license is important. Yeah. So whether the company has approved license in relation to that business or not, whether the license has an expiry date within a short period of time or not. Okay, whether all the approvals which were required to be obtained by the company were in place and on time or not. because many a times there could be certain non-compliances which may not be known to the company, which the company may have ignored, but which may result in a significant penalties in the future years. And those penalties at times are not immediately imposed. They may take time to come up. Yeah. And that's why all of these areas become very, very important on the part of the investor to understand and analyze, to assess their impact on the business. Because eventually, what's the objective of the investor? Investor wants that whenever he enters into this company should be away from any of the non-compliances. This should be a fully compliant company, and this should be performing in a manner which the investor would have expected when he invested in this company. Okay. Next, which at times is performed relates to the operations of the company. So we can say around the commercials or about the business potential. Whether the business has got the potential in the future years the way it's shown right now, or maybe the business has got the potential in the future years, but it may not be performing to that level right now. What are the ways through which the performance of the business can be improved upon? What are the ways through which profitability can be improved upon? What are the ways through which productivity can be improved upon? So any area which is towards the commercial side or towards the operation side is focused upon in case of this type of diligence. And as we have discussed, this diligence has nothing to do with the financial factors. This basically focuses only towards the operations, towards the commercial side. Okay, and that's why for performing such type of diligence, and in fact, for all of these type of diligences, you would understand that specialists are required. Let's suppose if the company which is targeting telecom business, then for this type of assessment, a person or a consultant who has got expertise, who has got specialization in this business should be involved. Because only then he will be able to comment upon it. Only then he will be able to give his suggestions, give his recommendations, give the improvement points. Yeah, for this type of diligence, a lawyer should be involved. Yeah, who will be talking about the diligences in terms of various compliances which are required to be performed. Yeah, here again we need a tax expert. Financial domain will be the finance side. Here operations will be the domain. Over and above all of these domains or the expertise over the domain, the industry knowledge of the consultant is very, very important. Because if the consultant would be knowing the industry well, he would be knowing everything about the investor, only then he will be able to get into an in-depth analysis. Otherwise, he may not be able to perform his job in a right manner. Next type of diligences, which at times is performed, is about the information systems. Okay, which is focused upon the IT environment. To look into the IT systems, to look into the systems, processes, procedures of the company, how strong they are, because some of the companies may be relying significantly in terms of their operations on this. Yeah, so that depends upon industry to industry. This is not something you'll get to see being performed everywhere or being focused everywhere. This is again a specific type of diligence which at times is required to be performed and at times is required to be focused on. Next is about the environmental due diligence. Environmental due diligence. What is this environmental? It's all about assessment of the business or the operations in terms of its impact on the environment. Longevity of the business. If we have to really understand whether the business will be able to sustain with the exact model with which it's been going on, and what are the consequences, what are the impacts which the business is having, which the company is having, which the industry is having on the environment right now. So this is really focused towards that sort of assessment on the part of the business, and at times this is also required to be performed. And next is about the personnel. Again, one of the areas which at times is required as part of the due diligence, and that is focused towards the personnel. Personnel is about the manpower, about the people, in terms of their competence, in terms of their size, in terms of their requirement in relation to the business, in terms of whether the size is good enough for the business, whether the entity is overly sized in terms of the number of employees which it may have. So there are various factors which are required to be considered. And once again, this is an area which is focused upon if the investor will have any concerns around it. Okay. So these are some of the due diligences, or you can say type of due diligences. And in the next session when we'll meet, we can continue with our discussion on this part, wherein we'll move on to some of the procedures related to this. Yeah, we'll move on to some of the procedures related to this, and we'll also see as to how all of those requirements will be then addressed by the consultant in his report, how the report will then be presented. Okay, so we'll get into the types of diligences with some of the very common procedures which we get to see in any of the types of diligences in the next session. So for the time being, if you have any questions, any doubts, we can have a discussion around it. And I would suggest all of you to just make sure that you are practicing the questions, you are revising all of these things. And this topic particularly, when we talk about due diligence, investigation, forensic audit, this is very, very interesting. And I'm sure some of those who are associated with any of these profiles, who would have performed these type of engagements, this is very, very interesting. And these have only increased in the current scenario. Yeah. So any of the questions from your side, you may just